Hi, everybody. Thanks for joining us. Thanks for the warm welcome. We are super excited to be here and welcome you to this investor AMA. In front of me or next to me, we have investors that represent the accelerator stage, seed, pre-seed, and growth stage. So really spans all of the different stages, and I hope you can take advantage of this opportunity to ask super tough questions to this team. So I'm Shannon Shroyer. I'm the head of network at Matchstick Ventures. I was with Techstars previously, and before that had a long career in fine and performing arts. I started my career as a professional ballerina, so atypical path to VC. But enough about me. Let's meet this panel. I'm going to start with Ryan. Ryan Broshar is a partner at Matchstick Ventures, also my boss. He ran the Techstars Target Accelerator previously. He was the founder of Beta and Twin Cities Startup Week. So thank you for recognizing that this ecosystem was
co-founder.
Co-founder. Yep. Ryan, I'm going to ask each of you this question. But Ryan, what's the craziest company that's ever pitched you?
Actually, I just got pitched this like 2 weeks ago. So it was a teleportation company, and it looked really legit on the front. And I was like, please make this happen. But there's no way I'm going to invest in this company in the least bit. So it had all the good components of a pitch. I had no idea to evaluate it, and I didn't want to be the first one to test it either. So we passed.
That's a good one. You're going to have a hard time beating that. So next we have Sarah Bain. She's with Techstars. She's the investment principal for Techstars, running the Minnesota accelerators, currently the Twins and Farm to Fork accelerators. Previously, she was working on the Target accelerator and started her career here in the Twin Cities at Target. Sarah, same question. What's the craziest company that's ever pitched you?
Hi, everybody. So in terms of company, it's terrible. I actually don't even remember what they do. But I'll talk about the pitch. And Ryan, you might remember this. It was our first or second year when we were running the retail program. And there was a founder who was clearly sitting down with his laptop on his lap. And he started his pitch. We were asking him a little bit about, tell us about what it is that you do. And we could hear somebody walking towards him being like, you can't be here. Like, you need to get going. And all of a sudden, the laptop just closed. And so the meeting shut off. And Ryan and I looked at each other and were like, okay, so do we think the meeting's over? We waited a couple minutes. 2 minutes later, this founder was then in their car giving us the pitch during his lunch period because he had jumped out of class early. He was in high school. He did move on to the next round of interviews because we appreciated the hustle so much. So cannot remember what they do at all, but appreciated the hustle nonetheless.
The future is bright. I like it. And last but not least, we have Dan Heck, who is currently a partner at Stage 2 Capital, previously a partner at OpenView, and he also started his career here in Minneapolis in merchandising at Target. Dan's investing experience spans seed through growth stages. So thank you for joining us, Dan, and same question.
Yeah, thanks so much for having me. Excited to be here. So similar to Sarah, instead of talking about the company, I'll talk about the situation, which was I was scheduled to meet a company somewhere in person on a trip, and I go to the meeting, and similarly, it's like, oh, hold on, wait 1 second, and the CEO decided that he wanted to have the meeting with like his entire company there, so it's a little bit weird if, asking questions like, well, what's your revenue? How fast are you growing? Like, what's your competition? And it was just very odd to have the entire meeting in front of the whole company. And then at the end, we would also open it up to questions. And it's like, oh, does anybody else have a question for Dan? And it was just it was a unique experience. Yeah, never had that happen before besides that one.
Did anyone else have a question for Dan?
I'm sure, I think people did. I don't know.
Are you going to invest?
The culture of the company was very open, which I appreciated in some sense, but yeah.
Well, great. We have some questions that came in advance, and we'll start with those, and then we'll leave time for the virtual audience. Please enter your questions in the chat, or everyone in real life, which is great to be back, right? So I thought we'd start with some basics, just in case there's folks with us who are new to the VC space or maybe fundraising for the first time. So super basic. How do VCs make money? Anyone want to take that? Or should I call on you?
I can take that one.
Great.
So I think this is always like a black box, right? Like, how do we make money? Like, there's a couple different ways, right? There's a general VC fund is we go out, we raise money from individuals. They're called LPs or limited partners. We pool that capital into a fund, and then that fund then invests into different startups. And the goal of a VC is to take that money, this box of money, if you will, and then produce multiple boxes of money to return that back to our investors later on. And so the way that the VC makes money is actually any of the profit, so the extra boxes of money that are returned, we get a small percentage of that. And that's basically like a percentage of it's called carry, but think of it as almost profit of the company. So the managers themselves will get a piece of that. We also get a management fee, which is just a percentage of the fund that we get on an annual basis to manage the fund, to make the investments, to work with the companies, et cetera, on behalf of that. So you've got a fee component, and then you have a carry component. And really, the fee is it should be just to keep the lights on, to support your staff, to be able to operate the company. And really, the main thing that the VC is looking for is the returns, because that's very much aligned with why people invest in your fund. So, I don't know if I missed anything.
Yeah, no, that's definitely correct. The only thing I would add is like the amount of your compensation that's determined by like the management fee component versus the carry component will be very different normally, depending on like where you are in the organization. Or for entrepreneurs, you might be talking with VCs, like if you're speaking with somebody who's earlier in their career versus more established. And the reason that's a good thing to think about and understand is if you think about the carried interest, it's very aligned with the success of the company will yield financial success for the investor as well. And if folks are early on in their career or just getting started, don't have as much carry, if those folks are going to be in the board, it's a good thing to remember and understand that, like, okay, they may be incentivized differently or things like that. But yeah, by and large, those are the two components for sure.
Great, thanks. And how do you all find companies to talk to?
I can start. I would imagine we all have some similar ways. But for me, at Techstars, an accelerator, a lot of our pipeline is actually coming from other accelerators. There are many other great accelerators out there. And so we're looking at places like Beta, like Generator, and a variety of other accelerators, and looking at pitch competitions. But a large number of the companies coming through are referrals. But we're very proactive on our side, letting people know that we're actively looking for companies. Applications are opening. We're getting close to the deadline. Do you guys know any good companies? But for the most part, our team is recruiting and sourcing all the time, looking at different accelerators, different pitch competitions, and having conversations with other VCs. And so I would say the main one, though, is really through other accelerators.
For Matchstick, we were a regionally focused fund. So we cover the Rockies in the North regions, kind of upper Midwest. And so a lot of our deal flow actually comes from being embedded in these markets. I have a partner, Natty, who's based in Boulder, Colorado, and so he's on the ground. He's talking with startups regularly. So it is an advantage of being a regionally focused fund is that you are on the ground. We're at events like this. We're meeting startups all the time. So a lot of our inbound comes from just having been in the market. Another area that we see a lot of deal flow from is actually we've got over 100 companies that we've invested in over the course of the 3 funds. And so a lot of our companies we get referred to are actually from portfolio founders. They're also in the company, they meet with other founders all the time, and they'll refer a company over to us. And that's really one of our top areas for finding deal flow. And then third, they talked about this a little bit in the earlier panels, but we actually have a lot of entrepreneurs in the regions are actually investors in our fund. And we do that on purpose. We actually allocate a huge amount of our seats that are available for investment to entrepreneurs because they're working with other entrepreneurs, they've had success, but also like after we make an investment, they help support our companies. They've got a built-in interest for that. So they end up referring a lot of companies to us through those channels. So those are our 3 main ones for Matchstick.
Yeah, so Sarah and Ryan mentioned, other investors, other entrepreneurs, the portfolio. Another one that we see, so at stage 2, we kind of have this interesting setup where a lot of our investors are like CEOs, CROs, CMOs of large software companies. So, HubSpot, Asana, Slack, like Salesforce, Oracle, all those types of folks. And those folks, obviously, a lot of them are seeing new companies just by virtue of a lot of them are angel investors, a lot of them are looking for solutions within their companies. And so speaking with operators at people who are companies that are buying software regularly is another one that, we really kind of take advantage of, particularly given our focus. And then the other one that, especially, when I was kind of later stage in the growth stage, very much like other investors is a really big part of it, and chatting with folks like Sarah and Ryan, but also trying to be outbound and intentional about, okay, I think a certain idea or a certain, archetype of company is particularly interesting. Obviously the internet, you can find pretty much anything. So let me go see what is out there that fits, that idea that I have. And then reaching out directly to those entrepreneurs and hopefully getting them excited about the prospect of working with us enough that they would reply to an email from a random person they've never met before. But that is definitely a big way too, at least for my style.
Thank you. This is one of my favorite questions to ask really anyone and our founders and CEOs in the portfolio. But what's the hardest part of your job? And I know that changes every day, but Sarah, I'll start with you again.
Sure. Just because this is top of mind right now, I would say one of the hardest things for me is having to say no to a founder. It sucks. It is not fun. And so we've been in the process of having conversations for the program that we have with the Minnesota Twins. And so having to say no at this time of bringing in the 10 companies that we bring in is not fun, but it's a part of the job. You get to know these people, you're having conversations with them for a year, 6 months, maybe even more. And so having to say no at a given time is really not fun at all.
Yeah, I mean, definitely agree with Sarah. That's really draining. One of the big ones for me, there's so many great people out there starting so many interesting companies, and I also am committed to work with companies whether I'm on the board or supporting them as an investor. And then you also have the companies that you've spoken with, and then we have want to build relationships with LPs and potential investors as well. And so I find that like time management and being really intentional about where I spend time, why I spend time there, what companies I decide to reach out to, not reach out to, what companies I decide to spend more time doing more diligence. How do I make sure that I'm supporting every company in a way that's like respectful, especially for companies where I'm on the board or in the portfolios. You've made a commitment to them, and you obviously want to follow through on that commitment. But there's a lot of competing priorities and competing things happening all at once. So being really intentional and thoughtful about time management is definitely one that comes up for me.
Anything different for you, Ryan?
No, the no part is the worst. It just sucks because you get to know someone through the course of getting to know them and their company. Having been a founder myself, I can relate very much to like what it's going through, and just the having to say no, and then justify that, and then see those people in the community and everything, and try to support them in other ways. But that saying no part is just brutal.
I can imagine. So don't quote me on these numbers, but I recently read that only 1% of VC funds go to Black founders and only 2% to women. That obviously doesn't reflect the makeup of our country. So what are each of you doing to help diverse founders get funding? And Dan, you want to start?
Yeah, for sure. I think the biggest thing is just intentionality, awareness of what any of our backgrounds are, where any of our networks are, and then supplementing or augmenting that where you have gaps. And I think that's true on any dimension, and certainly these in particular. So, making sure that we're looking at stats to say, okay, in our pipeline, what percent of our pipeline, what percent of our diligence, what percent of our portfolio is from, underrepresented founders or, women. And so making sure that you're being, again, intentional and keeping track of those things and saying, okay, if this isn't where I want it to be, if it's not representative of the general population of entrepreneurs, then we need to be doing a better job, and we need to be more intentional, and we need to be building relationships with those people, not just from the networks of that we've had in the past or that we can come naturally to us because they're the people that we've cultivated relationships with over 5, 10, however many years, and more it's okay, if we need more, if we think we need to be having more conversations with a certain type of person, let's go out and meet more people in those communities, talk with more of those companies, and build out more of those networks so that those stats, all up and down the pipeline are more representative of, the culture, the country, and the population of entrepreneurs that we're trying to serve.
Yeah, I agree with all of that. I think for us, once again, top of mind for the sports tech program that we run, one of the big things was making sure that we set initiatives of having key goals of wanting to have more conversations and giving the opportunity to have more conversations. My team has made a very intentional goal of always having a conversation with a founder. No matter who they are, no matter what they look like, we will at least have one conversation because we want to learn about what it is that their company does. Whereas before, it may just be sign up for office hours. So if anybody reaches out, somebody on my team will have that conversation, but it's also us making sure that we're going to different organizations, having different conversations that we were maybe not having before, and partnering with other organizations that we may not have had direct line of sight into prior to.
And for Matchstick, this is very near and dear to our heart. Just recently, about a year and a half ago, we came out with very public initiatives around increasing diversity within our portfolio and how do we support the different communities in our regions. Being a regionally based fund, this means a lot to us, right? We live in these communities, we want to see them thrive, and we want to support entrepreneurs of all things. And it manifests itself a couple different ways for us. I guess the first thing is recognize both Natty and I as the partners are, very privileged white men who have the opportunity to be a VC, and we take that very seriously and recognize that kind of right out of the gate. And we feel like it's in that position, we need to honor that and be able to support and spread the capital that we get allocated evenly and try to change those numbers that you mentioned. So we've made initiatives very public about ways that we're trying to support this, and that includes, what we don't want to do is make a tokenized investment of just saying we're going to make X number of investments in this community. We don't think that's the right approach to it. As VCs, we still have to have very high bars for returns on our investment, and I think what we try to focus on instead is the top of the funnel. What are the communities that we can tap into? What are the organizations? Who do we not have exposure to from our immediate networks that someone else might have ability to introduce us to founders that we otherwise wouldn't be able to source just from people we know. So we're very intentional about seeking out other sources. We have quarterly goals specific to this about trying to increase our top of pipeline of diversity. The other thing we've been trying to do is increase the diversity of our team, of our advisors within Matchstick, of our LP base is very important as well. And we hope that just by being very intentional and public about the type of founders that we invest in, where we're trying to source our deals from, that has led to a very large influx of actual deal flow from that. And our numbers show, at Matchstick, the number of diverse founders that we have is almost, I think it's 4 times the national average. Those numbers, it's not 4% instead of 1%. I think it's more of our teams, it's over 50% of our teams have diverse founders on either as a founder or the CEO of the company. So we're really proud about that. But it's something we're continuing to work on. We're not experts at this. We're always open to new advice and always trying to continually improve.
Thank you. Let's shift topics slightly. This came in from someone in advance. Thank you. How do you feel the VC landscape will look over the next 12 months, given the current financial climate? Who feels like taking this?
I can kick it off quick. I was actually just in San Francisco last week, and this was actually one of the questions we kept asking. We're meeting with a lot of follow-on investors, Series A investors from all the mega funds out there, and just getting their kind of temperature of where everything is. And it's pretty interesting to hear their mood of where they are today and where they go. So they're a lot of times for situations like this where you're talking about the big macro environment, I tend to try to find other people that are way smarter than me and then kind of aggregate opinions around that. And I agree with some of their sentiment, but I think what you're seeing is in the market that really the growth stage stuff is stalled, if not very just hard to access right now. So we're saying B and C rounds. And then in the lower rounds, there's really a flight to quality, right? So if your company is doing really, really well, you'll have really no problem raising. I shouldn't say no problem. It's not going to be as hard to raise, but if your company is struggling or isn't in the top quartile or of stuff that VCs are seeing, it's going to be really hard because there's just a lot more, people are a little more hesitant with their capital. But there is still a lot of capital. Deals are still getting done. Matchstick, we're investing same as we always have, steady as she goes. And but you're just starting to see you'll see some of that, I think, trickle through to even the earlier stage rounds over the next 12 months.
Anything else to add, Dan or Sarah?
Yeah, I think, obviously nobody knows for sure. I think Ryan kind of alluded to this in his answer, but the big variable that is kind of hard to square with a really prolonged slowdown is just the amount of capital that people have committed that they do need to deploy. Normally, fund cycles are 2-3 years in terms of how much time it takes you to invest and build that portfolio of companies. Obviously, it's more than 3 years to see it all through, but in terms of when you're deploying, the majority of that capital, maybe more than a majority, 70%. And so, the funds are literally, no exaggeration, bigger than they've ever been. And so something does have to give there a little bit. I'm sure fund cycles will be a little bit longer. People are going to, they were deploying really quickly 18 months ago. They're going to deploy a lot more slowly now. But there is, like I said, more capital than ever that needs to get out there. And so I think the big thing, and this is, for entrepreneurs out there, I think something worth thinking about is there is right now a glut of companies, especially with how the market was 12, 18 months ago, that, raised really high priced rounds well ahead of where their traction was. And so that's really where there's kind of this slowdown or difficulty that Ryan was alluding to with the question, the question behind the question. And those companies are, it's hard to raise when you say, okay, we have these people want to give us money. We're not quite to that valuation yet, but hopefully we'll get there in 2 years if we do exactly what we want to do. And that doesn't leave you a lot of margin for error. And what happens is when you start to need to raise the next round, you go back out. Most investors are going to say, okay, but the last round price was X. I assume you don't want a price lower than X, which is normally a very safe assumption. It's like, well, we can't really justify in this new kind of valuation environment investing at a price above X. And then you're kind of in a really tough spot because you can't raise a new round. You're kind of just slowly spending the money that you raised in the past. There's all sorts of talent acquisition things going on there too. And so to the extent that there's kind of a change in the mindset of like, okay, how far ahead of traction do I want to raise? What am I comfortable with paired with all the money on the sidelines? Like, I do think, it'll pick up a little bit, more than a little bit, but it's not going to happen overnight. And I don't think it'll go back to necessarily where it was 12, 18 months ago, at least in the next 12, 18 months.
Can I add one thing? I think it would be a missed opportunity if I didn't say this, being on the accelerator side. There is capital there, but now and into the next 12 months, I'd be remiss if I didn't say that accelerators would be a really, really wonderful path. And I say that because there's already capital there to be deployed. We have resources. We have set mentors. We have set investors in the network. And so it's a great opportunity for companies to get an investment and to get an access to a whole network of people that they may not necessarily have access to before.
Great answers. I like this question, and it's a little lighter, a little more fun, but what excites you the most about an investment opportunity? Is it the team, the idea, the market, or something else? What are you looking for? Not what are you looking for. What excites you?
Probably all have a different answer.
Sarah, go first.
I can go first. For me and for the stage that we really invest in, we usually look at 6 different things, but the first 3 are exactly the same, and that's team, team, team. And so one of the things that excites me the most is, where are these founders as people? Where are they at in their business? What trajectory have they had? Have they been founders before? Have they had great experience? How do they work together as a team? And so I know that's more than one thing, but it really is the founders.
Yeah, I think, especially the earlier stage you go, the founder and his or her approach and skill set and fit with the market opportunity is just such a big determinant of success. I think, later stage, so I would say even later stage, that's, one of, if not the most important thing. A few other things just to throw some other things into the mix. Like the 2 things that I would say I look for beyond, the standard, revenue and market size and all that type of thing. One is kind of a concept of like defensible competitive advantage. So, if a group of Google engineers woke up tomorrow and looked at your company and said like, oh, that seems really cool, I think we're going to do that. Like, why would you win instead of them? And there could be all sorts of reasons. It could be network effects. It could be something about your knowledge of the market. It could be your kind of the data that you've already accumulated and the advantage that gives you in terms of the insights and the quality of product you can deliver. But some kind of tangible, differentiable, explainable thing that determines, why you would win as opposed to some other really smart, really talented, really driven person. And if you look at kind of the biggest companies in the world or the biggest winners in venture, pretty much every company has something like that. And the second is this concept of like, why now? Like, why should this company exist today? Why hasn't it been built in the past, but why will it be a really big opportunity in the future? Again, world of 8 billion people, a lot of them really, really smart with access to, great technology and talent. And so, probably somebody has had this idea or concept or notion before, and maybe has even tried to build it and it hasn't worked. And yet, for the company to be successful, it needs to be really big in the future. And so, if you think back to, it's always easy to say, after the fact, ex post, but like something like Uber, I'm sure anybody would want to order a cab and have it show up instantly for a long time, but that couldn't really exist until GPS technology was good enough, semiconductors were small enough to fit inside a phone, Apple developed the app marketplace. Like it's a whole confluence of factors that coalesced around 2009 to 2013 that made that opportunity like the right time for that company to be built. And obviously Uber and Lyft kind of built really big businesses on top of it. But that why now and that defensible competitive advantage, two big ones that I look for in addition to obviously team.
Matchstick, we steal the Techstars stuff a lot, having been there, so we do a lot of team stuff. We're very early, so a lot of it is qualitative analysis versus quantitative. And one of the qualitative areas we look for is, you might hear a lot about like product market fit, so like is your product in the right market at the right time? What we look for very early on is founder market fit, and like, is there some reason that this person is building this company? Like, what is the backstory? What is the why to this company? And a lot of times, and if you look across our portfolio, it is chock full of founders that have some sort of why behind they built this. Like, either they felt the problem of the pain they had, and they said, I have to do this. They recognized an opportunity, and they just became obsessed with it, over the last X years or something. Maybe their family was like in a business that was this, and they're the next generation, and they have it. But you have these kind of founders that have this feeling behind them that they were like put on this earth to solve this problem, right? Like they just nerd out on talking about whatever it may be. And so when we start to see those kind of very early on connections between like the founder, why this company, and where they go, what you start to see is that they have more resiliency and grit behind their willingness to grind it out through the company because they care so much about it. They're not just there to like make a quick buck. They're there to solve this problem, right? Or they're just obsessed with it that they need to do. So it usually correlates to some sort of success in the future, just because if we believe in that founder, their story, and in the market is there, there's a lot of good indicators of future success.
The other thing, sorry, Shannon, one other thing, because I realize I'm the semi-designated later stage person, so I should probably talk about like metrics and numbers too, which obviously, especially the later you go, the more important and influential that is. And so just to give a sense of like what folks at like that Series A, B, C type of stage are looking for. My background and my experience and most of my investing career has been spent in software, so I'll focus on that. But some of these, I think these concepts actually apply to any business. The specific numbers will be different, but I think about the financials and unit economics of a company in really three main buckets. One is momentum, one is front-end efficiency, or what I call front-end efficiency, one is back-end efficiency. And essentially the idea behind it is like momentum is just like how quickly are you growing, which is really indicative of like how much does the market want this product, and how effective are you at distributing that product to the market. And so to give you an idea of like what is, because I think sometimes it's hard to say, or like it's not super transparent like what investors are looking for. At least for us or at prior funds I've been at, like what is good for momentum is like if you're tripling, that's good. If you're quadrupling or above, that's like really best in class. And it really depends on the scale you're at too. So again, coming from the software lens of things, if you're like $1 million ARR or less, you want to be closer to that 4x. If you're between 1 and 5, like if you're tripling, that's good. If you're between 5 and 10, like even if you're doubling, that can be okay. If you're tripling, that's really strong. And so, for all the really big, brand name funds out there, if you're tripling and you're 5 million or so, like that's really strong. You're kind of checking the box on that dimension. This concept of like front-end efficiency, the way I often look at it is payback. So basically, how much money are you putting into your like go-to-market machine, and how quickly is that money coming back? And so the way I think about it is you would take your revenue, then you'd adjust it by your gross margin, like how much money you make on every kind of purchase that a customer makes likes of your product. That's like how much margin you're generating. A lot of folks use revenue instead of margin, but I think it's important to use margin because gross margins are very different across businesses. And then you compare that to how much it costs you to acquire that revenue. So a common way to calculate it would be, how much did you spend in sales and marketing last quarter, both outbound, like on things like Facebook ads and paid social or Google, and also the cost of your team. Obviously, that's all going into that endeavor, and you compare that to how much you generated, and then you can calculate a payback time period. Basically, if you're less than 12 months, that would be like best in class. 12 to 24 months is like good. Above 24 months, again, none of these are like deal breakers, but just give you a sense. Above 24 months would be below average for like the top tier VC type companies. And then the last one, what I called like back end, is basically how do customers behave after you acquire them? And ideally, what you want to see as an investor is, okay, if a company starts out and spends $100 in month one, like they spend more than $100 in the future as opposed to less than $100. And so the way that a growth stage investor would typically look at that is say, like, okay, you look at all the customers acquired in this particular period, including the ones that have churned, including the ones that have expanded, everything. If month one they spend $1,000, hopefully by month 12 they're spending, on average $1,200, $1,300, something like that. That would be good. If you look at, public software companies, best in class, like a company like Snowflake, which I'm sure a lot of folks have heard of, they're, 170, 180%. That's like really best in class. And so, if you're below 100%, that can sometimes be a danger zone. Again, not a red flag, but I've been talking for a while now, so I'll stop, but hopefully that's helpful for folks.
No, that was super helpful. Thanks. I feel like you really lifted the curtain and kind of let us in. So with that, I want to open it up to, yes, great, to the audience. Please, I'm going to wait for the microphone to reach you.
Hello, thank you all for being here today. My question is pretty straightforward. If you guys can't answer, then I'll just be curious to what's the most creative business model you've seen. But I'm interested to learn about what is the dry powder that your VC has available to invest in the next 12 to 18 months. Probably after 18 months, we'll be back on in bull market. And if you guys can share, that would be great. Otherwise, the second question.
Thank you.
Yeah, I can take that one. So we just raised a $53 million fund but basically like 1 year ago. And the way we deploy our capital is over the course of 3 years. So we've got about 2/3 of our capital still left to invest. So I don't know, that's hard math in my head, but about 2/3 of 53 is still available to invest.
What's the largest check size you've done out of those 2/3?
1.5 million.
He asked what the largest check size was for those virtually.
Yeah, I'm happy to answer also. So stage 2, we're investing out of our third fund. It's $150 million, brand new, just announced. So, still have like 135 million of it available to invest. And I think maybe the question behind the question too of like, well, how much do you have in the next 18 months? Our philosophy is, whatever your strategy is, you should be investing when the prices are high, low, whatever. It's hard to time the market. So definitely still investing. We just wired money into something last week. Yeah.
What was your follow-up, your
Oh
question?
yeah, check size?
Yeah. Largest
Yeah, so we'll write checks as small as $2 million or so. We'll write checks as large as, $8 or $10 million or so.
And have you invested in any traditional method businesses with plans, I guess you could say, year 1 is a traditional business model, and then by year 6 and 7 it goes more to the software model?
I'm trying to think. So we definitely see businesses transition from like services to software all the time. I think normally, at least for our stage, since we're a little bit later, we want some of those proof points like already kind of in the financials. But I do think that's like a common path, and so it's one worth pursuing. And but yeah, in terms of our focus, it doesn't have to be 100% software, but at least some of those early proof points of we have customers paying for the software, not the services, is normally the best place for us to get involved.
So this is Calvin again. I was fortunate to complete my current fundraising round. You brought up the word transparency, and I feel like from a founder's perspective, that is something
So I can take that. I think transparency is crucial. Like I will say like the amount of transparency in VC has gone up a lot. Like in last year, I've been investing now for almost 10 years, and to go where it was before to say just like no, to now saying like no and here's why, or saying, hey, these are the things that get you to a yes. Or these are the type of companies that has come a long ways, but I see and hear stories all the time of just kind of the black box that you can go into as a founder for sure, of like understanding like, am I pitching the right person? Why did they say no? Like where that goes. So I would say like a little bit of advice, I guess, on the back end of that too is like as a founder, it's really okay to be asking the VC like, what is the what do you invest in? Like what is your path to a yes? And they should have, hopefully if they're a sophisticated investor, they'll have some sort of like process that they're putting in place for it. And then at least you'll know like where you are in that process and know if this is going to be a waste of time or not, kind of out of the gate. But I know you guys at Techstars deal with this all the time too, of just like how do you target the right type of investor based on your company, and it's really hard. It's really, really hard. Maybe I'll let you take that, like how you guys work with them.
Yeah, I think we're having the conversations with our companies all the time, even before. Transparency is a very big thing for me and my team, and we will always let founders know why we said no. And if they want to have follow-up conversations, we will most definitely have follow-up conversations. And so it's not just a soft no, it's a no, not right now because of X. But in terms of finding the right investors and having the right conversations with investors, I think one of the greatest things you can do when you get to a certain point with an investor is to talk to portfolio companies that are currently in their portfolio. Have the conversation of what are these people like as investors? Are you actually having transparent conversations with them? Do you feel like you know what you're doing well and what you're not doing well? And so reach out to other founders. Founders are always willing, in my experience, to have other conversations with other founders. And so make sure that you're doing your research and your diligence on the back end of investors and making sure you're getting into a relationship with an investor that you really want to work with.
I think we are nearing the end, so I want to grab another question over here. I saw some hands, so sorry to keep this moving. If we can get a mic over there. Oh, sorry, I saw some hands over here. Yes, we have a green shirt and an orange shirt over here. We'll do speedy answers, so.
I'm also willing to have conversations with anybody after, too.
Yeah, me too.
For all this long question, now I ask a quick question, but and I think to founder fund fit, but like we don't want to leave our company. We never want to sell it. We want to build legacy that's going to last generations. How does that fit with your needs to, generate revenue and additional resources for your investors?
Sure. Yeah. So, I think with venture capital, there's this kind of, very open agreement between like why we make an investment, and I guess in return, like what are the expectations of the company. So if you take venture capital, the expectation is that you're taking the capital to exponentially grow your company over the course of the next 10 years with an expectation that you would seek some sort of exit into the future. It's becoming more an option to not have the company like completely exit while the investors can still get out by doing secondary sales or anything. But the expectation is very much like we're going to be buying a portion of your company and giving you the capital to really grow the company. Now that doesn't mean like your company's not good or anything if that's not the agreement that you're looking to do. There's plenty of other options for financing of a company, but there is that kind of built-in expectation of like accepting venture capital and kind of what the agreements are. Last, I do think there is a lot of alternative financing out there now that is outside of VC that is completely normal. I don't think VC is like you got to do it if you want to have success. Like, that is not the case at all. There's a very much a subsection of financing businesses that VC lands in. So, I would be exploring kind of all those options before you decide to, like, hey, I have to have VC to have a successful company, because it's just not true.
And we are over time, but we'll do one last question until we get kicked off.
Perfect. Okay. So on that first meeting, what are some things that really impress you that a founder brings up or talks about, and then what are some of the biggest turnaways or turnoffs for you guys?
Sarah or Dan, do you want to jump in?
Sarah, you do like 1,000 of these.
I would say one of the things that I always want to know is what is their big vision and how they're going to take over the world. And you always say, when Ryan and I were working together, it was always, what's your evil plan? So how are you going to win at the space, essentially? And I want to know the way you're thinking about it and what your answer is to it. So that's, if you don't tell me that, I'm going to ask that. And so it's one of the things that impresses me most, is if a company really tells me that before I have to ask.
Yeah, in terms of the other side of the coin and turnoffs, I can share too. And in general, the thing that I'm always looking for is like somebody with that big vision, somebody who has a ton of optimism and like really wants to build a big company, but is also honest with themselves and realistic and objective. And so two things that can kind of like trip the radar there is, or three things, I guess, actually. One is like, if I ask like, well, competitors or alternatives, like who else is out there? If they say like, oh, nothing else is out there, like there's never been anything like this ever, like we're the greatest, and like everybody will know it. That might be true that there aren't any direct competitors, but there's probably some alternative out there, whether it's, spreadsheets, whether it's a different company with a similar mission that's going about the problem in a different way. And so I always find that to be a tough answer, just because I think it belies some of that objectivity and like realism that's important in building a company. Another one in the same vein is market sizing. If people say like, oh, our market is $1 trillion, but the company doesn't exist yet, like it's unlikely that a market that big has not been tackled. Now there might be like $1 trillion of addressable spend, and you're a marketplace, and you take some percentage of that, and like if you're objective and like show that math equation, I think that's totally fine. But if it is more of that pie in the sky, like it's $1 trillion according to the one research report, end of discussion, like boom, that can sometimes be tough. And the other thing in a similar vein is just financial projections. Anytime I see a company that's like, yeah, we're going to be 1 million this year, next year we're going to be 20, the year after that we're going to be 200, the year after that we're going to be 1 billion, and we're going to like be taken on Google, like again is like pretty much no company in the history of the world, not literally no company, but very, very an infinitesimally small percentage grow that way. And so again, a trajectory and a plan that's like realistic and ambitious and gets you to a place that like you're really excited about, that investors will be excited about, but it isn't just the pie in the sky. Like I took this number, I multiplied it by 5, then I multiplied by 10, then I multiplied by 20, and like here we are.
Thank you. Thank you, everyone. We are happy to talk after this, and you can send us questions also on social channels. We'd be happy to answer there as well. So thank you so much for joining, and sorry that we ran over.
Thanks, everybody.
Thanks, everyone.